Hello, dear friend. Welcome to Books and More, a quiet corner where we gather the essence of transformative works to offer you a path toward wisdom. We know your time is precious, so we distill the core values of great books, allowing you to embrace deep knowledge while keeping your soul nourished and your journey efficient. In a world that often feels like a storm of shifting numbers and economic whispers, it is easy to feel overwhelmed. We wonder about the invisible hands that shape our daily lives and the stability of the ground we walk upon. Today, we step into a journey through history and hope with Bernanke's 21st Century Monetary Policy. This remarkable work provides a profound look at how the Federal Reserve has navigated the most turbulent waters of our time, from the heavy clouds of the Great Inflation to the unprecedented challenges of the global pandemic. As we begin, I invite you to consider these questions. How do the choices made in moments of crises echo through our own personal stories? Can we truly find a sense of balance and security in an ever-changing financial landscape? And what can the lessons of the past teach us about protecting the world for those who come after us? Understanding the complex forces of our world is more than a technical pursuit. It is a way to find clarity amidst the noise and to reclaim a sense of peace through knowledge. You are not alone in your search for stability. We are here with you, turning the pages together. I wish you a journey filled with deep insight and a heart that feels grounded. Let us open this chapter and begin our exploration into the history and future of our century. Introduction. I remember watching Jay Powell walk up to the podium on January 29, 2020, to start his first press conference of the year. At the time, his message was optimistic. The American economy was in its 11th year of record growth, and unemployment was at a 50-year low. Even when a reporter asked about the new coronavirus, the tone remained cautious but calm. We had no idea how quickly everything was about to change. Only 5 weeks later, the world was unrecognizable. The virus had spread globally, and financial markets were suffering their worst week since the 2008 crisis. I had led the Federal Reserve through that earlier crisis, so I understood the immense pressure Jay and his colleagues were facing. However, while the 2008 crash took nearly 2 years to fully unfold, the pandemic hit like a tidal wave all at once. By April, unemployment had jumped to nearly 15%, and 20 million jobs had vanished in a single month. The Fed had to move with unprecedented speed, reaching for the 2008 playbook while also working with Congress to invent entirely new tools to keep the credit flowing and the economy from collapsing. My own journey into this world began as a graduate student at the Massachusetts Institute of Technology in the late 1970s. My mentor, Stanley Fischer, handed me a massive book on the monetary history of the United States by Milton Friedman and Anna Schwartz. That book fascinated me. It showed how outdated theories and simple mistakes by central bankers could turn a standard downturn into the catastrophe of the Great Depression. I spent much of my academic career studying those failures, and that historical perspective guided my own time as chair. I believe that you cannot truly understand the tools, strategies, and communications of the modern Fed without looking through this historical lens. This book is my attempt to explain how the Federal Reserve evolved into the institution it is today, and how it might change in the years to come. I believe 3 major economic developments have defined the modern era of central banking. The first is the changing nature of inflation and its shifting relationship with the labor market. The second is the long-term global decline in neutral interest rates, which has left central banks with much less room to cut rates during a recession than they had in the past. The third is the persistent and growing threat of systemic financial instability, which can cause devastating damage even to advanced economies. To understand these shifts, we will look at the history of the Fed, starting from the post-war period through the current day. While my focus is on the American experience, I also draw on the lessons learned by other major central banks that have faced similar challenges. These institutions are often misunderstood, but their goals are essential for anyone trying to make sense of our contemporary global economy. By learning from the mistakes and successes of the past, we can better prepare for the uncertainties of the future. Part 1. 20th Century Monetary Policy: The Rise and Fall of Inflation. When I look back at the history of the Federal Reserve in the 20th century, the story is dominated by a single, painful, and ultimately transformative era we call the Great Inflation. Before the mid-1960s, inflation was rarely a concern for Americans outside of wartime. In fact, for much of the early 50s and 60s, price increases were remarkably low, averaging just over 1% a year. But a series of intellectual missteps and political pressures changed everything, leading to a two-decade struggle that would fundamentally reshape how we think about money and the role of a central bank. The trouble really began with the well-intentioned economic optimism of the 1960s. At that time, many economists believed in a simple and permanent trade-off called the Phillips curve. The idea was straightforward. If we wanted lower unemployment, we just had to accept a little more inflation. It seemed like a menu of options that policymakers could choose from to find the perfect balance. Under the Kennedy and Johnson administrations, this led to a push for aggressive growth. President Johnson wanted both guns and butter, meaning he wanted to fund the Vietnam War and his ambitious Great Society programs without raising taxes enough to pay for them. This massive surge in government spending heated up the economy, and soon the labor market was stretched thin. My predecessor, William McKesney Martin Jr., was the longest-serving chairman in our history and a man of great integrity. He famously said the Fed's job was to be the chaperone who takes away the punch bowl just as the party is getting started. In late 1965, he tried to do exactly that by raising interest rates to head off inflation, but he ran into a wall of political fury. President Johnson was so enraged that he summoned Martin to his ranch in Texas to personally berate him, telling him that men were dying in Vietnam and the Fed should not be making it harder for the government to borrow money. Under this intense pressure, and with many of his own advisors suggesting that the economy still had room to grow, Martin and the Fed hesitated. They didn't tighten policy enough or hold it long enough to stop the inflationary momentum. By the time Martin left office in 1970, inflation had climbed to nearly 6%. The 1970s brought even greater challenges under Chairman Arthur Burns. Burns was a brilliant scholar, but his tenure is often remembered as a low point for the Fed's independence. He shared a close relationship with President Richard Nixon, and White House recordings from that era reveal a president who was not shy about demanding easy money to help his re-election prospects. Burns also held a flawed view of why prices were rising. He believed that inflation was driven by things outside of the Fed's control, like the power of big labor unions and monopolies, or the dramatic oil shocks of 1973 and 1979. Because he didn't see inflation as a primarily monetary problem, he was reluctant to use high interest rates to fight it. He thought the social cost in terms of unemployment would be too high for the public to bear. This resulted in what we call stop-go policy. The Fed would raise rates when inflation got too scary, but then quickly back off as soon as the economy slowed down or unemployment ticked up. This inconsistency was disastrous. It allowed a dangerous inflation psychology to take root. People began to expect that prices would always go up, so workers demanded higher wages and businesses raised prices in anticipation. This created a self-fulfilling wage-price spiral that seemed impossible to break. By the end of the decade, inflation was in double digits, and public confidence in the government's ability to manage the economy had completely evaporated. The turning point came in 1979 when President Jimmy Carter appointed Paul Volcker as chairman. Volcker was a man of immense physical and moral stature who understood that the only way to stop the spiral was to break the back of inflation expectations once and for all. He knew it would be painful, but he believed it was the only way to achieve long-term stability. In a dramatic move in October 1979, he changed the Fed's entire operating procedure. Instead of focusing on interest rates, the Fed would now focus on strictly limiting the growth of the money supply. This was as much a psychological move as an economic one. It sent a clear signal to the markets that the rules had changed. The cost was indeed high. Interest rates soared to 20%, and the country fell into a deep and grinding recession. Volcker faced intense criticism from every corner of society. Farmers drove tractors onto the National Mall to protest, and home builders sent him pieces of lumber with messages of despair. Yet, with the support of both Presidents Carter and Reagan, who largely respected the Fed's independence during this crisis, Volcker stood his ground. He didn't blink. By the mid-80s, inflation had finally collapsed to around 4%. The cycle was broken. Volcker had proved that a determined central bank could control inflation, but he also taught us that the price of waiting too long to act is a much more severe and painful correction later. When Alan Greenspan took the reins in 1987, he inherited a Fed that had regained its credibility. Greenspan was a pragmatist who spent his days poring over mountains of data to find the pulse of the economy. He spent much of his early years cementing Volcker's gains. One of his greatest successes was the soft landing of the mid-90s. As the economy began to heat up in 1994, Greenspan moved preemptively, raising rates even though inflation was still low. He wanted to head off the problem before it started. While this caused some short-term turmoil in the bond markets, it worked. The economy continued to grow without an inflation breakout. The late 90s presented a different kind of puzzle. We were seeing a boom in technology and the early days of the internet. Usually, when unemployment falls as low as it did then, we expect inflation to rise, but it didn't. Greenspan had the insight to realize that we were experiencing a surge in productivity. Because technology was making workers more efficient, companies could pay higher wages and keep unemployment low without needing to raise prices. He allowed the economy to run hotter than the traditional models would have suggested, and the result was one of the most prosperous periods in American history. However, this era of stability, which economists later called the Great Moderation, brought its own set of risks. With inflation under control, our attention began to shift toward the dangers of financial instability. The 1987 stock market crash, the Asian financial crisis of 1997, and the collapse of the dot-com bubble in 2000 showed that even in a world of stable prices, the financial system could still produce massive shocks. Greenspan tended to believe that the Fed should not try to prick these bubbles while they were growing, because it was too hard to know for sure if a rise in asset prices was a bubble or a genuine reflection of economic value. Instead, he believed the Fed should focus on cleaning up the mess after a bubble burst by providing liquidity and lowering interest rates. By the end of the century, the Fed had become a vastly different institution than the one created in 1913. We had moved from a bank that simply managed the gold standard to a modern central bank with the independence to set its own course. We had learned that transparency and clear communication with the public were vital tools for managing expectations. Most importantly, we had learned through the hard experience of the 70s that price stability is not an alternative to a strong labor market, but a necessary foundation for it. As the new millennium dawned, we felt we had mastered the old challenges, unaware that a new set of even more complex crises was just over the horizon. Part 2. The Global Financial Crisis and the Great Recession. The transition into the 21st century brought challenges that would have been unrecognizable to the central bankers of the previous generation. As I stepped into the role of chairman of the Federal Reserve in 2006, I inherited a legacy of stability known as the Great Moderation. But beneath the surface, a new set of economic forces was already at work. We were moving into an era defined not by the threat of runaway inflation, but by the risks of low growth, falling interest rates, and a financial system that had grown far more complex and fragile than we realized. The early 2000s were marked by a long-term decline in the neutral rate of interest, the rate that neither stimulates nor restricts the economy. This shift was driven by deep structural factors like aging populations and a global glut of savings, which meant that interest rates were likely to remain low for the foreseeable future. While this seemed beneficial at first, it presented a dangerous trap. With rates already low, the Fed had very little room to cut them if a recession hit. We began to look closely at the experience of Japan, which had struggled with zero interest rates and deflation for years, and we were determined to ensure that the same fate did not befall the United States. At the same time, a massive bubble was forming in the American housing market. This boom was fueled by a psychological wave of optimism and by the rapid growth of securitization, where mortgages were packaged into complex financial products and sold to investors around the world. These innovations were supposed to spread risk, but they ended up hiding it instead. By the time house prices peaked and began to fall in 2006, the rot had spread deep into the financial plumbing. We initially hoped for a soft landing, a gradual cooling of the market that wouldn't derail the broader economy, but the reality proved much harsher. The crisis that began in 2007 was not a typical economic downturn, it was a systemic financial panic. This was a modern version of the bank runs of the 19th century, but instead of people lining up at teller windows, it was large financial institutions pulling their funding from one another in the shadow banking system. Markets that corporations used to fund their daily operations suddenly froze. As a student of the Great Depression, I knew that if the financial system collapsed, the damage to the real economy would be catastrophic. We had to act as the lender of last resort, a role the Fed was created for in 1913, but we had to apply it to a financial landscape that had changed beyond recognition. The collapse of Lehman Brothers in September 2008 was the breaking point. It triggered a global earthquake that nearly brought down the entire system. We worked around the clock with the Treasury Department to prevent a total meltdown, rescuing institutions like AIG and supporting the passage of the TARP program to recapitalize the banks. But even as we stabilized the panic, the economy was falling into a deep hole. We had cut our target interest rate effectively to zero, yet the economy still needed more help. This was the moment we had to move beyond the traditional playbook and into the world of unconventional monetary policy. Our primary new tool was large-scale asset purchases, which the world came to know as quantitative easing, or QE. Since we could no longer lower short-term rates, we decided to buy long-term securities, including treasury bonds and mortgage-backed securities. By doing this, we aimed to lower long-term interest rates, making it cheaper for families to buy homes and for businesses to invest. Our first program, QE1, was a massive effort to restore function to the mortgage market and signal our commitment to the recovery. It was an experiment born of necessity, and while it was controversial, the evidence suggests it prevented an even deeper disaster. As we moved into 2010, the recovery remained frustratingly slow. Unemployment was stuck at high levels, and the risk of deflation was still a concern. This led us to initiate QE2, focusing on treasury purchases to further ease financial conditions. We also began to realize that our communication was a policy tool in itself. We developed forward guidance, telling the markets that we intended to keep rates low for an extended period. The idea was simple. If investors knew rates would be low for years, long-term rates would fall even further today. The final major evolution in this period was the launch of QE3 in 2012. Unlike our previous programs, which were fixed in size and duration, QE3 was open-ended. We promised to continue our purchases until the labor market showed substantial improvement. This was a powerful statement of intent. At the same time, we officially adopted a 2% inflation target to provide a clear anchor for the public's expectations. These steps helped support a long, if slow, expansion that eventually saw unemployment fall to its lowest levels in decades. Looking back on those years, the lesson is clear. In a world of low interest rates and complex finance, the Fed must be both creative and transparent. We had to invent new ways to support the economy when our old tools failed, and we had to learn how to communicate our plans to a skeptical public and a volatile market. The journey from the depths of the 2008 panic to the eventual recovery was long and difficult, but it redefined the role of the Federal Reserve for the 21st century. Part 3. Monetary Policy, from Liftoff to the COVID-19 Pandemic. When I handed the baton to Janet Yellen in early 2014, the Federal Reserve was entering a delicate and historically unprecedented phase. After years of keeping interest rates at zero to combat the aftermath of the 2008 financial crisis, we were finally looking toward what we called liftoff. This was the process of beginning to normalize monetary policy by raising rates and eventually shrinking our massive balance sheet. Janet was the perfect leader for this transition. As a labor economist by training, she brought a deep understanding of how our decisions affected the lives of ordinary Americans, and she moved with a characteristic combination of intellectual rigor and great patience. The road to liftoff proved much longer and more winding than any of us initially anticipated. For decades, the Fed had operated under the assumption that a very strong job market would eventually trigger a spike in inflation. However, as the unemployment rate fell lower and lower during Janet's tenure, inflation remained stubbornly below our 2% target. We began to realize that the fundamental mechanics of the economy were shifting. We spent a great deal of time analyzing the neutral rate of interest, which we often call R-star. This is the interest rate level that neither speeds up nor slows down the economy. We discovered that this neutral rate had fallen significantly compared to previous decades, meaning that even very low interest rates weren't as stimulative as they used to be. At the same time, we saw that the Phillips curve, the historical link between low unemployment and high inflation, had flattened. These insights suggested we could afford to be much more patient in raising rates, allowing more people to find work without the immediate fear of overheating the economy. External shocks also played a major role in delaying our plans. In late 2015 and through 2016, global markets were rattled by a sudden devaluation of the Chinese currency and the surprising vote in the United Kingdom to leave the European Union, known as Brexit. These events created a sense of global instability that threatened the U.S. recovery. We had to be nimble, often pausing our rate hikes to ensure that these international headwinds didn't blow us off course. By the time Janet's term ended, we had successfully begun the process of raising rates, but it was clear that we were operating in a new normal of low growth and low inflation. In 2018, Jay Powell took over as chairman. Jay brought a pragmatic, non-academic background to the role, which proved essential as the political environment became increasingly hostile. For the first time in the modern era, the Fed faced constant public attacks from the White House. President Donald Trump was not shy about criticizing our decisions to raise interest rates, often via social media. Jay's strategy was to remain focused on our mission, communicate our decisions in plain English, and build strong bipartisan support in Congress. He emphasized that our independence was crucial for making the right long-term decisions for the economy, regardless of the political cycle. By the end of 2018, it became apparent that the Fed's tightening might have gone a bit too far. Market volatility increased, and the yield curve actually inverted, meaning long-term interest rates fell below short-term ones. Historically, this has been a reliable warning sign of an approaching recession. Jay showed remarkable flexibility by leading a significant policy pivot in early 2019. We stopped raising rates and eventually moved to cut them 3 times. We viewed these as insurance cuts, preemptive strikes to sustain the expansion in the face of trade wars and a slowing global economy. This proactive approach helped extend the longest economic expansion in U.S. history, demonstrating that the Fed had learned to be more responsive to market signals rather than blindly following a set path. Everything changed in early 2020. What began as a distant health concern in China rapidly transformed into a global catastrophe. The COVID-19 pandemic caused a sudden vertical drop in economic activity as cities and states across the country shut down to save lives. The financial markets went into a tailspin that felt eerily like the dark days of 2008, but happened much faster. In March 2020, even the market for U.S. Treasury securities, the very foundation of the global financial system, began to freeze up. Investors were so desperate for cash that they were selling anything they could, and for a few days, the system was on the verge of a total collapse. Jay and the committee responded with a whatever-it-takes attitude that was both massive and immediate. We cut interest rates back to 0 in 2 emergency meetings and began an open-ended program of large-scale asset purchases to restore market function. Working with the Treasury Department and with the support of the CARES Act passed by Congress, we revived our emergency lending facilities from the 2008 crisis and created new ones. We went further than ever before, establishing programs to support credit to corporations, municipal governments, and even small and medium-sized businesses through the Main Street Lending Program. We were acting as the lender of last resort, not just for banks, but for the entire American economy. As the immediate panic subsided, we took the opportunity to complete a major review of our monetary policy framework. We recognized that the biggest threat in the modern era was no longer high inflation, but rather the danger of falling into a trap of permanently low inflation and low interest rates, similar to the experience of Japan and parts of Europe. We adopted a new strategy called flexible average inflation targeting. Under this new approach, we would no longer raise interest rates just because the labor market was strong. Instead, we would wait for inflation to actually reach our 2% goal and even allow it to run moderately above that level for some time to make up for previous shortfalls. We also redefined our employment goal to be broad-based and inclusive, focusing on the groups that typically face the highest barriers to finding work. The recovery from the pandemic was as unusual as the crash. As the economy reopened in 2021, supported by massive fiscal stimulus and our easy money policies, demand surged while the world's supply chains remained broken. We saw a spike in inflation that was far higher and more persistent than our models had predicted. For most of that year, we believed these price increases were transitory, a temporary shock that would fade as ports cleared and workers returned to their jobs. However, as 2021 drew to a close, it became clear that the inflationary pressures were widening. We had to pivot once again, preparing the markets for a much faster end to our asset purchases and an earlier start to interest rate hikes than we had previously communicated. This period, from the first tentative steps of normalization in 2014 to the explosive recovery of 2021, has been a transformative chapter in the history of the Fed. We emerged with a much more powerful and flexible toolkit, but we also learned that in a world of global pandemics and shifting economic structures, our most important asset remains our ability to adapt and our commitment to an independent, data-driven approach to the public interest. Part 4. Looking ahead. Monetary policy in the 21st century. The world I navigated as a policymaker changed profoundly from the one my predecessors knew. For much of the 20th century, the central challenge was keeping a lid on high inflation. But as we moved into the 2000s, we found ourselves facing a different reality. The traditional tool of moving short-term interest rates began to lose its edge as those rates hit zero, and a new normal emerged where inflation and interest rates were consistently low. This shift forced us to look beyond the old playbook and develop a new set of tools to support the economy during the Great Recession and again during the pandemic. Two of the most important additions to our toolkit were quantitative easing and forward guidance. When we could no longer lower short-term rates, we turned to the bond market, buying massive amounts of treasury and mortgage-backed securities to push down long-term rates. This helped families afford homes and businesses invest in the future. At the same time, we began talking more clearly to the public about our future plans. By signaling that we intended to keep rates low for a long time, we gave markets the confidence to recover. While these tools were once seen as radical and sparked fears of runaway inflation, they proved to be effective and manageable. Experience has shown that they don't just work in a crisis, they have become a permanent part of how we manage the economy. However, even with these new tools, I had to ask whether they were enough. The fundamental issue is that the natural level of interest rates, what economists call the neutral rate, has fallen significantly over the last few decades. This is driven by global trends like aging populations and slower productivity growth. Because this neutral rate is so low, the Fed has less room to cut rates before hitting zero. This makes it harder to fight deep recessions. We have found that our new tools can provide a boost equivalent to several percentage points of rate cuts, which is significant. But in a very severe downturn, even this might not be enough to fully restore the economy. To make our policy more powerful, we have looked at what other central banks have done. In Europe and Japan, they experimented with negative interest rates and controlling the entire shape of the bond market's yield curve. While I believe we should keep an open mind about these options, they come with complications. Negative rates can be unpopular and might squeeze bank profits, while controlling long-term yields could require the Fed to buy an unlimited amount of debt if investors lose faith. We also updated our overall strategy by adopting a flexible average inflation targeting framework. The idea here is simple. If inflation stays too low for a while, we will purposefully allow it to run a bit above our 2% goal for a time to make up the difference. This helps keep people's expectations about the future stable and gives us more firepower when we need it most. One of the most difficult questions I've grappled with is how monetary policy relates to financial stability. We all remember how the collapse of the housing bubble led to the global financial crisis. Some argue the Fed should raise interest rates to pop bubbles before they get too big. I have always been cautious about this approach because interest rates are a blunt instrument that affects the entire economy. Trying to stop a specific bubble by raising rates might throw millions of people out of work. I believe our first line of defense should be strong regulation and supervision, what we call macroprudential policy. By ensuring banks have enough capital and following the money in the shadow banking system, we can make the financial foundation more resilient without damaging the broader economic recovery. Ultimately, the Fed's success depends on its independence. It must be able to make decisions based on data and long-term health rather than short-term political pressure. That independence is a trust granted by the public, and to maintain it, we must be transparent and accountable. In recent years, the Fed has also been asked to play a role in addressing broader social issues like climate change and economic inequality. While the Fed does not have the tools to solve these problems on its own, those are primarily the responsibility of elected officials, we can and should contribute where our expertise matters. This includes researching how climate risks affect the financial system and ensuring that our pursuit of maximum employment reaches all communities, especially those that have historically been left behind. As we look toward the future, the Fed will continue to evolve, whether it is through the potential development of a digital dollar or refining how we communicate with the public. The institution must remain flexible. The lessons we learned from the Great Inflation, the financial crisis, and the pandemic have reshaped our understanding of what a central bank can do. We have learned that while we cannot prevent every shock, we have the capacity to innovate and act decisively to protect the livelihoods of the American people. The journey is far from over, but the tools and frameworks we have built in this new century have prepared us for the challenges yet to come.